Hello everybody, welcome to all of you. Now in this course, we are going to start the journey of finance and for your exam purpose, strategic financial management. It is not only for your exam purpose, but also it is for your life purpose also. Life purpose means in every field of your life, you have to take decision with respect to finance and the subject or the paper what you are going to learn. I hope if you can learn properly, it would help you in every step of your life. Okay. Now strategic financial management approximately we would cover in 180 hours because 60 hours we can reduce as it is a recording classes. You can watch by pausing it, you can note down by pausing it. For that purpose 60 hours approximately time we can reduce. I hope within a time span of 180 hours or 160 hours we can complete this course. Let us see. Start. Now before we start the subject or before we start the paper, let us see this paper belongs to which group, this paper consists of how much mark, what are the question pattern, how many mark being asked from the theoretical portion, how many mark being asked from the numerical portion, all those things we would see and some brief idea we would get with respect to this particular paper, and after that we are entered into our topic one by one. Okay. Now the paper strategic financial management, it is in our group 1. Paper number 2, total mark is 100. Now in the question paper we would see totally 6 questions would be asked. Question number 1, 2, 3, 4, 5 and 6. Each question normally consists of 3 parts. Part A, Part B and Part C. Okay. So see question number 1, 2, 3, 4, 5, 6. Totally 6 questions should be there. Each question normally consists of 3 parts. Part A, Part B and Part C. Normally, Part A consists of 8 mark, Part B consists of 8 mark, 8 plus 8, 16 and Part C 4 mark, 20. But there is no such hard and fast rule. There may be exception to the rule also. Now, out of these 6 questions, question number 1 is compulsory. Question number 2, 3, 4, 5, 6. That means out of the remaining 5 questions, you have to answer any 4. So for the first question, no alternative available to you. You have to attempt it. From the remaining 5 questions, you have to attempt any 4. So total number of questions you have to answer 1 plus 4 means 5. Each question 20 mark. 20 into 5 means 100 mark. Out of that 100 mark, numerical consists of 80 mark and theoretical consists of 20 mark. Numerical 80 mark and theoretical consist of 20 mark. It is the designing of our paper. Okay. Now, the question is, what are the fundamentalism of strategic financial management that we would understand first? Sir, fundamentalism, what does it mean? To understand fundamentalism, I can give you one example of your accounts paper or financial reporting paper, whatever may be. Now for the paper or for the subject accounts, if you ask me what are the fundamentalism for the learning, I would say there are 5 pillars in the paper accounts. What are the 5 pillars? Pillar number 1, it is your income. Pillar number 2, it is your expense. Pillar number 3, it is your asset. Pillar number 4, it is your liability, and pillar number 5, that is equity. So 5 pillars are there: income, expense, asset, liability, and equity. You would see whatever may be your chapter in accounts, whatever may be your journal entry, whatever may be the presentation, whatever may be the accounting treatments, everything are based on these 5 pillars: income, expense, asset, liability, and equity. Similarly, this paper, strategic financial management, if we see, it consists of how many fundamental pillars? Actually, 3 fundamental pillars. It consists of 3 fundamental pillars. What are the 3 fundamental pillars? Pillar number 1, it is your risk. You have to understand the meaning of risk. You have to understand how to quantify the risk. You should have the skill to analyze the risk, and based on that one you have to take your decision. So first pillar is risk. What is the second pillar? The second pillar is valuation. You have to learn how to make the valuation of an asset, and the third pillar is, it is your return. So these are the 3 pillars for this paper, strategic financial management or SFM: risk, valuation, and return. Valuation can be done with the help of the risk and return. So first risk comes into play, then return, and at the end valuation comes into play. Now for the purpose of decision making, you have to understand higher risk is good or lower risk is good. Higher valuation is good or lower valuation is good. Higher return is good or lower return is good. That basic knowledge I hope you have. One by one risk. Risk means actually uncertainty. Higher the level of uncertainty, everybody dislike it. All of us we like actually certainty. So what I can say, higher the risk level, it is a bad indicator. Lower the risk level, it is a good indicator, other thing remaining constant. Similarly, valuation, from the viewpoint of the owner, higher the valuation, it is a good thing. Lower the valuation, it is bad thing. Similarly, from the viewpoint of the return, higher the rate of return, it is a good thing, and lower the rate of return, it is a bad thing. Whenever I am talking about risk, I am assuming other thing remaining constant. Whenever I am talking valuation, I think other things remaining constant. Whenever I am talking return, I am thinking other things remaining constant. But for the decision making purpose, maybe one parameter would not be enough to decide. You have to consider 2 or more parameters, whatever may be. When we would proceed one by one, we would learn how to analyze the risk, return, as well as the valuation. So what I want to tell you, that the paper strategic financial management is based on the 3 basic pillars. 3 basic pillars are risk, valuation, and return. Okay. Now, in the next part, what I am going to do, what we are going to learn in this paper. Few examples I want to tell you, so that in the day 1 you would get some idea throughout the course, throughout the paper, what we are going to do, and overall idea we would get. For that purpose, few examples I want to state here. First one, you see, A Limited wants to acquire B Limited. A Limited wants to acquire B Limited. So consideration to be paid by A Limited to B Limited. A Limited acquiring B Limited means A Limited has to pay consideration to B Limited. The question is, how much consideration to be paid by A Limited to B Limited? Answer would be, it would be value of B Limited. What does it mean? For the purpose of determining the consideration, we have to learn how to calculate the value of a business, in this case value of which company? B Limited. Not only B, suppose for the purpose of acquisition, A Limited would issue shares to the shareholders of B Limited. So how many shares of A Limited to be issued? For that purpose, we have to calculate value per share of A Limited. That means what I want to tell you, to determine the amount of consideration, valuation of A Limited as well as B Limited to be done. It means we would learn how to make the valuation of business. I told you three pillars: risk, return and value. In every problem you would see, either they are asking to calculate risk, or they are asking to calculate return, or they are asking to calculate value, or they are asking a combination of any of these three. In each and every problem you would see. Okay, that is your issue number 1. Issue number 2, another example you take. A debenture is trading in the market at the rate of rupees 1200. Mr. X is planning to invest in debenture. One debenture is trading in the market at rupees 1200 and Mr. X is planning to invest in the debenture. The question is, should he buy debenture? Answer may be yes, answer may be no, answer may be depends. Actually, yes is not a good answer. No, it is not a good answer. The better answer would be it depends. How does it depend? Now, whenever we are buying an item, we should buy it provided that it is undervalued. We should not buy it if it is overvalued. So whether this 1200 is undervalued or overvalued, we have to calculate the fair value of debenture. The fair value of debenture may be 1200. Fair value of debenture may be more than 1200. It may be less than 1200. If it is more than 1200 is the fair value, so fair value is more. It is trading in the market at a lower price. So we can say it is undervalued in the market. We should buy the debenture. On the other hand, fair value of the debenture is less than 1200, suppose 800. If 800 is the fair value, we should not pay 1200 for the item. That means he should not invest in such debenture. So what I want to tell you, we have to determine the logical value or fair value of the debenture. You see, for this purpose, Mr. X has to calculate the logical value or fair value of debenture. If the logical value or fair value is rupees 1200 or more, only then we should buy it, otherwise not. It means we would learn how to make the valuation of debenture. That means again in my issue number 2 you see valuation coming into play. In the first case it was valuation of business. In the second case it is coming valuation of debenture. Third issue. Mr. X is holding 800 shares of Bajaj Finance. Current market price per share is rupees 6200. Should he continue to hold the shares or sell? Similar logic. Again, we have to calculate the fair value of the share of Bajaj Finance. If fair value is more than 6200, it is trading at rupees 6200. Should we sell it? Answer is no. We should hold it. On the other hand, if the fair value of the share is less than 6200, but it is trading in the market at 6200, we should sell the share. You see, for this purpose, Mr. X has to calculate the logical value or fair value of shares. If the logical value or fair value is less than rupees 6,200, he should sell. It means we have to learn how to make the valuation of share. So all the three examples you see based on valuation. In the first case it was valuation of business. In the second case it was valuation of debenture. In the third case it is valuation of shares. Issue number 4. A Limited and B Limited are issuing bond. Bond means debenture. These two bonds are identical with respect to face value, issue price, their life as well as redemption price. These two bonds are identical from the viewpoint of face value, issue price, their life and the price at which it is to be redeemed. But coupon rates are not same. Coupon rate means actually interest rate. Their coupon rates are not same. Bond A is 10% coupon rate. Bond B is 12% coupon rate. That means if we buy the bond A, 10% interest we would earn. If we invest in bond B, 12% interest we would learn. Now the question is, due to higher coupon rate, should we invest always in bond B? Should we invest always in bond B? Apparently looking yes, but the answer would be no. Because 10%, 12%, whatever may be, it is from the return viewpoint. With the return, always you have to consider the risk also. If investment in bond B is subject to higher level of risk, never we should invest in bond B. That means what I want to tell you, only return calculation is not enough for the purpose of decision making. We have to consider the risk factor also. One example I can tell you to understand it better. Suppose you have rupees 1 lakh surplus for 1 year. You can make fixed deposit with SBI. SBI would pay you 10% rate of interest. You can make the fixed deposit with me. I would pay you 12% interest. SBI would pay you 10%. I would pay you 12%. Ask yourself, you would like to invest your money in fixed deposit with SBI or fixed deposit with your teacher? I know your mind saying that I would make fixed deposit with SBI. Why? Teacher is giving you more return, SBI giving you less return, till you are moving to SBI only due to what factor? Risk factor. Risk means uncertainty. You know, if you put the money with SBI, it is more or less guaranteed. Your interest you would get, your repayment of principal also you would get. But if you put your money with the teacher, there is no guarantee that teacher would pay you interest or teacher would pay you your principal amount. That means investing your money with the teacher is more risky as compared to SBI. So in spite of the lower interest rate, you would like actually SBI as compared to teacher. Do you see? Should we invest always in bond B? Answer is no. We have to look into return, that is coupon rate, as well as what you tell me, risk. Only return is not enough. Side by side we have to look into risk. It means we would learn how to measure risk as well as analyze risk in connection with investment in bond. How to calculate risk or how to measure risk, how to analyze risk, that also we have to learn. Issue number 1, 2 and 3 I told you value perspective. Issue number 4 it is your risk perspective. One more example. Mr. X has a bond portfolio. Bond portfolio means the collection of the bond in which money has been invested. Suppose 5 types of bonds I have purchased. My bond portfolio would include all these 5 bonds. The portfolio, that is this bond portfolio, consists of 5 bonds, that is bond A, B, C, D and E. It is expected that market rate of interest would decrease. In the bond chapter, we would see when market rate of interest changes, our bond portfolio value would also change. So it is expected that market rate of interest would increase. Mr. X does not want to change his total investment in bond portfolio. Bond portfolio value would be affected, but he wants to remain invested in bond. He does not want to buy any other asset. Now you see, can we formulate a strategy so that the effect of change in market interest rate in the bond portfolio would be less? Can we change the portfolio structure in a scientific, in a logical manner so that if there is any adverse impact on the bond portfolio, the impact would be lower? The answer is actually yes, and that is known as we would learn how to manage a bond portfolio. Bond portfolio, how we can manage, that we would learn in our paper Strategic Financial Management. Issue number 6. A Limited has outstanding bond with coupon rate of 12%. A Limited has outstanding bond with coupon rate of how much? 12%. Outstanding bond. Outstanding bond means bond already issued or bond to be issued. Bond already issued. With coupon rate how much? Tell me. Coupon rate is 12%. Okay. Now, A Limited can issue new bond with coupon rate of 9%. A Limited now can issue a new bond with coupon rate of 9%. You see, looking into these two, one point should strike your mind. One point should strike your mind. Looking into these two, one point should strike your mind. What point should strike your mind? Your mind can say that existing bond we are paying 12% interest. New bond we have to pay only 9%. Should we issue the new bond to replace the old bond? Because for old bond our cost of capital is 12%. For the new bond our cost of capital how much only, you tell me? It is only 9%. So should we replace the old bond by the new bond? You see, should A Limited redeem the old bond by issue of new bond so that cost of debt would be less? Such kind of decision we have to take in the paper Strategic Financial Management. Issue number 7. A Limited wants to issue preference share. Issue price would be fixed in such a way that the investor enjoy a rate of return of 10%. The company wants to fix the issue price in such a way that the investor who would subscribe in that issue, they would enjoy a rate of return how much? 10% per annum. That means we would learn how to fix the issue price to fulfill a particular objective that we would learn in our SFM subject. Next one. A portfolio consists of shares of 5 companies, say A, B, C, D and E. A portfolio consists of 5 shares A, B, C, D, E. What is the risk and return of the portfolio? The portfolio as a whole, how much is the risk, how much is the return, that we may be interested to know. It means we have to learn how to calculate risk and return in connection with investment in equity shares we have a chapter which is known as the portfolio management. In this chapter, we would learn it. Issue number 9. There are hundreds of mutual funds in the market. If an investor wants to invest in mutual fund, which one is to be selected? You have surplus money, you are interested to invest in mutual fund. Thousands of mutual fund schemes are there. In which mutual fund you have to invest, you have to decide it. It means we have to analyze the performance of the mutual fund. We have to understand their risk level. We have to understand their rate of return. Risk and return we have to analyze, and after analyzing, we may find out the better one in which investment should be done, and that we will do in the chapter which is known as the mutual fund. You see, performance of evaluation is again analysis of risk and return. Last example, Mr. X has imported goods. Invoice amount is $10,000, payable after 6 months. So Mr. X has imported goods. Invoice amount is $10,000. It is payable after how many months? 6 months. Now, if Mr. X does nothing today, so what would happen? After 6 months, Mr. X has to buy dollar from the bank at prevailing market rate. Now, standing on today, what would be the prevailing market rate after 6 months? It is certain or uncertain? Uncertain. That means Mr. X has entered into uncertainty. Uncertainty means risk. So Mr. X has entered into risk. In this paper, we would learn how that uncertainty can be converted into certainty, which is known as the management of risk. You see, standing on today, exchange rate after 6 months is uncertain. It means cost of import in INR, it is uncertain. Can we formulate a strategy so that cost of import in INR would be certain? Can we formulate a strategy so that cost of import in INR would be certain? Answer is yes, and that we will learn in the chapter Foreign Exchange Risk Management, which is my first chapter. Anyway, such strategy is nothing but management of risk. Okay, so these are just few examples. If you have understood, it is good. If you have not understood, it is very good. When the respective chapter would come, respective theory, respective discussion, respective numericals we would do, your concept would be clearer and clearer. So these are just few examples what we are going to do in this particular paper, that is strategic financial management. That's all with respect to my introduction with respect to strategic financial management. In the next session, we are going to start the first chapter, which is known as the Forex. Forex means foreign exchange risk management. So bye everybody.